Right, welcome back to another video. Today I want to talk about how we pick stocks, how we pick index funds, ETFs, things along those lines. Do you follow rumors, news, trending, what is actively trending, or history? Or maybe a mix of some and a little bit of a dash of each one. That's going to be kind of up to you for doing your own research. I just kind of want to go through my side of things on what I do and how I go about it. If you find this video interesting, if you like the concept, please hit the like button, share with a friend. It helps out tremendously, gets more people to watch the video. We're going to get into some of the metrics that I use for my own investing strategy. And there's a few major ones here, and I've covered them in previous videos if you want to go back and watch those. One of the biggest metrics that I use that guides my investing strategy is going to be growth. Growth is going to be your earnings per share, your income, your operating income, and your revenue. Having growth across the board in multiple aspects of this can actually dramatically improve a stock's price and their value. They're going to be reporting earnings every quarter, yearly, things along those lines that you need to pay attention to when you're picking a stock or an ETF or whatever it may be. And making sure that they have active growth or good reasoning as to why growth decreased or increased, whatever it may be. But following the growth patterns actually allows you to begin your research in the correct spots more times than not. Another major metric that I like to look at is cash flow and or positive cash flow, or why they don't have positive cash flow, right? Obviously, they need to be making money in order to have positive cash flow. That's a huge part of it. That's something that I look for in every single company that I invest in is going to be positive cash flow. More cash on hand means that they have more investment opportunities and more room for expanding their own business, maybe into other sectors or increasing their own competition. The third is going to be a moat. Every single company out there effectively is going to have some version of competition, whether it's just a little dash of it, meaning not direct competition, indirect competition, but having a strong and wide moat is going to be very valuable to a company, especially when it comes to their share price and their earnings and how strong and resilient the company is going to be. Obviously, the more competition, the less they can charge for their service or uh, goods, whichever it may be. So you want to make sure that they have a nice wide moat, strong moat that is pretty much going to put them at the top of that asset. Their leadership is another major aspect. You got to make sure when you're doing your research, you're actually looking at who's leading the company, what kind of leader they actually are. Are they pro growing revenue? Are they pro cash flow? Do they do dividends? I know that's further down the line, but are they a leader that likes to increase their dividends every single quarter, year, whatever it may be? But actually listening to what they're saying and following and seeing if they're truthful, if they're honest, whatever it may be, you gotta look into the leadership because if you have poor leadership, then you're gonna have a poor company. Another major aspect is going to be debt and debt versus cash on hand. Do they have debt? If so, how much? How much do they have in assets, short term assets that can be considered cash on hand in order to pay down debt? Essentially, is the company going bankrupt? Are they growing their debt more than their revenue and their income? Where are they at with that? Are they paying down debt? Are they doing stock buybacks? Are they starting dividends? What are they actively doing with their extra money? And are they using it wisely? That's kind of what the debt tells you, or to me, it tells me, I should say. Market sentiment and related news is also going to be very valuable in a company because if they have poor sentiment, it don't matter if you have good news, that the stock may still go down. If you have great sentiment and you got okay news, the stock may still go up. So you got to kind of figure out the history of the market sentiment with that stock and how news actually correlates to their price, depending on if you're looking for short term gains, long term gains, what it may be. And then future guidance and earnings. It is amazing how much that actually directly affects the stock price. You can have great earnings for a quarter, but if they put out a future guidance of weaker earnings the next quarter, then that significantly affects a stock price or a sell off, buybacks. All of that is going to be directly correlated to the future guidance, and it's going to result in their stock price, their share price. And then the last one I have here is going to be dividends. I love dividends. I think it's a great aspect. You're getting rewarded for owning a portion of the ownership of the company, so the shares. I think that's just a great concept of being able to reward those who are holding that company's shares for the long run. There's a couple of things with dividends. I'll get into that in a later video of when to buy them, should you reinvest them, all that kind of stuff. But I think a dividend paying company and showing that they're loyal to their ownership is a metric that I like to watch, that I like to see. Are they increasing, decreasing, things along those lines. Moving on here, we're going to go into buy the rumor and sell the news. If you remember that first slide, I had rumor, news, trending, history. These are all going to be aspects of what you need to do. So the basis behind stock market is money in, money out. When I say that is when you're buying a share, you're actually buying that share from somebody or an entity at that price. So you got more people selling, share price goes down. You got more people buying, share price goes up. Very basic, but ultimately it comes down to that. So you got good news, you got good rumors going around, then typically the price is up there. The reason why we have this saying is buy the rumor and sell the news is typically by the time the news reports it and you hear about it through the news, it may already be towards that point that it may be too late. So we learn about bell curves in school, right? And that's essentially what every single growth cycle is going to consist of, because you're going to have sell offs, you're going to have the peak, you're going to have the lows, all that kind of what the bell curve follows, right? So if you're already towards the peak of that bell curve, and that's when you're hearing about it, and everybody's saying, Bitcoin is at 120, it's going to 150. You buy at 120, and guess what? It just hit 62,000 like last week. That's a terrible spot to be in when you bought at that 120, because now you have to make the decision: do you buy and move that money to a different asset because Bitcoin's going to continue falling and try to recoup some of that money? Do you hold for the long term thinking it's going to come back and you're going to be profitable? And if so, how long do you actually have to hold it? So that's where that saying comes into play. Buy the rumor, sell the news. Buy Bitcoin at $17,000 and then sell when the news is reporting it broke 100K. That would have been a great profitable opportunity. And then there's another saying out there that is early bird gets the worm, but the second mouse gets the cheese. The reason why I like this saying when it comes to the stock market is you get in early, you have the opportunity to make more profit, right? Simple risk to reward. You buy Bitcoin at 120,000, you're not really the early bird, right? You already missed that opportunity. But the second mouse gets the cheese. So when Bitcoin hits its peak and it comes crashing down 40, 50, 60%, that is an opportunity for the second mouse. the first mice that bought at 120 already got the trap slammed on them, right? They already broke their neck and they're hanging on if they're still hanging on. But the second mouse gets cheese. That's your time to come in and clean up. So that's the way that I go about it in my own investing strategy is if I already feel like I missed an opportunity, I may not want to buy while it's at its peak because I think it's going to go higher. I may wait until there's a sell off, until there's something bad in the news to be able to invest that money at a much lower valuation and be able to grow and have more reward with less risk, if that makes any sense. Research, research, research. You have to do your own research and you have to actually know where your money's going and what they have going on. I can sit here and tell you, go buy Amazon, you'll become a millionaire. That ain't true. You're not going to be able to go buy 5 shares of Amazon and be able to become a millionaire. You may have to buy a little bit of Amazon, a little bit of Nvidia, a little bit of this and that. Know when you need to sell, know when you need to pull profits, know when you need to cut your losses. But you have to do your own research to be able to have any of that going on, right? Always do your research and don't follow trends. Do not just follow trends. What was one of the biggest trends that we just lived through? NFTs. Everybody thought NFTs were going to be the next thing. Metaverse. Everybody thought Metaverse was going to be the next thing. Huge gaming opportunity, right? When's the last time you heard about either one? Outside of the major losses people took on these NFTs. Now, I'm not saying there won't be a future spike in any of it. I'm just saying you need to do your research, and if it doesn't make sense to you, you may not want to go into it. Buying an NFT for 100 grand and now it's $15, that's a huge loss. Sorry for anybody who got caught up in it and didn't do their research ahead of time, but just don't follow the trends. Typically, trends are trending already by the time you hear about them, and that means you're not going to be buying in at a good value aspect. Risk on markets can lead to huge losses. We've just been in a huge risk on market. It's all about AI, it's all about technology. And pretty much throw your dart at the wall that the dartboard's on and it lands, you're going to make money, right? In a risk on market. So these meme coins, people made a ton of money on them. Did everybody make money on them? No, somebody had to lose money for other people to make money. That means they got in early enough. They were able to get it at a better reward to risk ratio. And they sold at a profit to somebody who bought at the top and is just sitting there with 50, 60% losses and they don't know what to do. That's the kind of stuff you end up running into when you follow trends and you're investing without doing your research in a risk on market. Research historic trends and patterns to have comparable charts and metrics to use as a guidance. History tends to repeat itself. A lot of people forget about this. So when you have a market that is just going to all-time highs, you can look at the last time the markets went to all-time highs. What was the duration that it lasted? What caused it to start a downturn? You can look at all these and see where we're at today. You're always going to have black swan events that are going to cause things to be different this time, right? Sadly, when you hear people say it's different this time, it's more than likely not. And you need to look into what they're saying and look at the history behind it and see if there is a chance that some things may be different. But I guarantee you the market's going to be higher than it was yesterday, and it's going to be lower than it was yesterday at some point in our lifetime. It's just the way that it works. You have 60% gains, you have 20% losses. The key is to have the research and have the standing to be able to survive the lows and pull profits on the highs. When markets move, they can move quick. You can have 40% drops in a day. You can have 30% gains in a day. You just need to make sure that you have your own risk tolerance met. So if you're at all-time highs in your portfolio, maybe set up some stop losses so that way if the market does take a 40% downturn, you can pull some of that profit and you're not just stuck holding an empty bag waiting for it to refill. You can use a mix of information sources to guide where to begin in researching companies and funds. Going back to that first slide, you can take a look and when there's news, you can start looking into it. Right now everybody's reporting Bitcoin. They're talking about the NFL player that took his salary as Bitcoin, and he after 5 years he's only made 3%. Well, they're not reporting that a couple months ago it was 120K per Bitcoin and he like doubled his salary. But a lot of people don't want to look at that. They just pick and choose the little statistics that can be eye catching for you and get you to see and be like, oh, Bitcoin's evil, right? It's not necessarily evil. It is an asset class that you need to be able to do your research, know when to buy, know when to sell. And it has to meet your own risk tolerance. Analyze the risk to reward potential of a stock or asset class. I've already kind of covered that, so I don't want to go into it too much. But in reality, if you're looking at buying a Tesla stock or Meta, Google, whatever it is, and they're already into uncharted price territory, that might not be a good time to invest all of your money into it because your risk to reward potential may not be there if you're already double the previous high. You might have already missed out on most of the profits and you're going to be stuck holding that empty bag again, right? I'm not saying that you can't invest some money, just make sure that your risk to reward is following what you need and what you want. When investing and what money do you use and when? When investing, what money do you use and when? Do you use your emergency fund? No, never. Don't do that. Emergency fund's there for a reason. You need that money in case of an emergency. If you invest it in the market and it goes down, you no longer have it, right? Do you use your expenses? Your funding for expenses, your mortgage payment, car payment? No, never. You need to be able to eat, you need to have a roof over your head, and you need to be able to pay your bills. Extra incomes after bills are paid. Ding, ding, ding. That is the winner. So you have extra money at the end of the week. Throw it in the market. I'm not saying just throw it in the market. Please do your own research. But that's the money that you actually are going to be putting in the market. When investing, you want to keep some cash on the sidelines for investing opportunities. Once again, that risk to reward. When there's high reward with low risk, meaning a company that is a great company like the Sassageddon that's been going on, right? These are great, tried and true companies that are just getting obliterated in the market. It's great to have a little bit of cash on hand to start throwing a little bit into some of these companies, the CRM, the Adobe, now, Salesforce is CRM, but having that money set to the side so that way when these drops, you have the capital to be able to put in without having to come up with money or sell other assets that are doing well in the market or whatever it may be. Give them their time to shine by setting those stop losses and let them go to all-time highs potentially, and pull out when it's actually necessary, not when you feel like it's necessary. And don't forget money for taxes. When you pull money out, set some money to the side for taxes. Don't just keep reinvesting it. I've gotten hung up in it myself to where I don't pull out enough for taxes. And then all of a sudden I gotta sell some of my assets to be able to cover or use some of my alternate savings that I would have put into the market. Now it's got to go somewhere else and I miss out on other opportunities. And then we're going to talk about short-term to long-term holdings. If you want to just trade and make 30% every single day for the rest of your life, this is not for you. You're going to have better luck at a casino, sadly. The way the market actually works, the longer you hold, typically the better you do. In which case, I'm not talking about going and buying the cheapest stock out there right now and hold it for 10 years and you're going to be a millionaire. No, I'm talking about doing your research, holding good quality stocks or ETFs or index funds or mutual funds for a set period of time, 3 to 5 years, and you're going to do well. You're going to move with the market and you're going to see hopefully some returns. I say hopefully because if you buy at the high and it crashes, it may take you a little bit of time to be able to get back up there. We have the lost decade for a reason. People just didn't see the gains they should have been expecting. All right, using margin trading. This is something that's very scary for a lot of people, and it should be. And I'm just being realistic. You need to make sure you do your research before you try entering any of the margins or the leverage trading because your earnings can be greater, but your losses can be very, very significant. So, when should you use margin? If you're a beginner investor and you don't fully understand what margin is, never. Don't use it. Don't touch it. It's not for you. Throw your money into an ETF until you understand the market and figure out what kind of investing strategies you should follow. If you're a middle of the road investor, meaning you have a strategy, you're still learning the market, you may be able to use a small amount of margin, 5 to 10%. Now, what you got to realize is you are borrowing that money from a entity. So if you're using Fidelity, that's what I personally use, they allow you to margin trade. You can use a certain amount of money, but you're putting your money up as collateral essentially. Fidelity is not going to lose their money. So if your account drops to a certain point, they're going to start selling and they're going to get their money back. Now, you're taking it as a loan. So you actually do owe a percentage on that money. You got to think about it as a loan. Now, you may have a lower percent interest. That's great. You may have a higher percent interest on the margin trading, depending on who you buy it or borrow it from. So you got to make sure you're actually actively using the money in a good way if you are using it. Most people, I don't recommend margin trading. It's just not worth the risk for you to be able to do it. If you have $1,000 and you're able to margin trade $200, what is that extra 200 really going to get you, especially at a 5 to 10% interest? And it accrues daily. Don't forget about that. It is APY, but it does accrue daily. So every day that you borrow money or have the money borrowed, they're going to be tacking it on, right? Expert investor, depends on your risk appetite, but I still recommend less than 30%. I don't ever recommend more than really 20% unless you really know what you're doing. I actively use less than 10% myself, and I do my best to keep it under that. I don't want to lose opportunities, so I go through the cash I have on hand, and then if I think it's a good opportunity, I enter that little bit of margin. And then at the first opportunity I get, I put money back in and I pay the margin off, and then I start accruing my cash on hand again. Leverage trading. It's very high risk, not recommended for pretty much anybody. Small amounts of personal money with large amounts borrowed, you easily get wiped out. I'm not even really going to touch on leverage trading. I just don't recommend it. Pretty much for anybody, it's just not recommended. And then I want to talk about this little chart. So this actually shows the best asset class and the worst asset class per year for the last 20 years. So we're going to take a look in 2023, 2024, 2025. Large cap growth, large cap growth. This is going to be your S&P 500, your tech stocks, things along those lines. Last year, it was international stocks, followed by large cap growth. This is why I'm talking about history. So one of the big things is commodities. People are talking gold, silver, things along those lines, and they're saying that this is what you need to be in. Well, you can see back in 2011 to 2015, you had commodities negative 5 years in a row. That would have started being a good buying opportunity. Then you can see commodities positive, little negative, very positive, things along those lines that just causes us to have to do this research to know where we're going. You can see that not one asset is just top above the board to where you're going to win every single year. You're going to have years that everything was about negative. 2018 here, you had cash at 1.86%. bonds at 0.01%. Everything else was negative. The reason why I'm showing this is a diversified portfolio. The idea of a diversified portfolio, it's in the middle. It's never going to be top, but it should never also be bottom. So diversifying across some of these can ensure that you hopefully have the best standing at the end of the year for your gains. So with that being said, make sure you do your research before you invest in anything. Make sure you're using money that is in excess to what you need. And when you go to the barber, he tells you about this stock that he heard or cryptocurrency he heard. Do you go back home and just go buy it? No. Do your own research. Maybe next time you go, ask him how it's doing, and then you can have an informative conversation with him and see if he actually knew what he was talking about, right? If you learned anything from this video, smash the like button, and I will see you in the next one.